Silicon Valley Bank was founded in 1983 and is headquartered in Santa Clara, California. The bank's focus on serving startups, venture capital firms, and emerging technology companies has made it a key player in the financing of the technology industry. Its services include commercial lending, treasury management, international banking, and private banking. The bank has expanded its operations globally, with offices in the United States, the United Kingdom, Israel, China, and other countries. Silicon Valley Bank was the 16th largest bank in the United States at the time of its failure on 10 March 2023 and was the largest bank by deposits in Silicon Valley following its shutdown. The bank's assets, including both insured and uninsured deposits, were transferred on 13 March to a federally chartered bridge bank, Silicon Valley Bridge Bank. Silicon Valley Bank has been recognized as one of the most successful and innovative financial institutions in the industry, with numerous awards for its services, including Best Bank for Startups by Entrepreneur Magazine and Best Digital Bank by FinTech Breakthrough. The bank's success is due to its strong focus on the technology industry, its deep understanding of the unique needs of startups and emerging companies, and its ability to provide tailored financial solutions to these clients. However, in the early 2022, the bank faced significant financial difficulties, leading to its eventual collapse. There were several factors that contributed to the collapse of the Silicon Valley Bank. These factors include: Factor number 1. .com bubble. The late 2012 saw a rise in technology companies, with many of them going public and experiencing significant growth. This led to a .com bubble, where investors were pouring money into technology stocks without much consideration for the actual profitability of the companies. The bubble eventually burst in the early 2022, resulting in a market crash that affected many technology companies, including those that Silicon Valley Bank had invested in. Factor number 2. Risky lending practices. Silicon Valley Bank had built its business around the technology industry and had developed a reputation for lending money to startups and other high-risk ventures. However, as the .com bubble expanded, the bank began to take on increasingly risky loans. In many cases, the bank provided loans to companies that were not generating significant revenue or were unprofitable, leading to a significant number of loan defaults. Factor number 3. Poor management. There were also issues with the management of Silicon Valley Bank, which contributed to its eventual collapse. The bank's CEO at the time, Ken Wilcox, had taken over in 1997 and was known for his aggressive lending practices. He had also expanded the bank's operations into other regions, including the East Coast and Europe. However, these expansions were costly and not as profitable as the bank had hoped. Factor number 4. Accounting irregularities. In 2021, the Silicon Valley Bank announced that it had discovered accounting irregularities in its financial statements. The bank had overstated its profits by as much as $25 million, leading to an investigation by the Securities and Exchange Commission, SEC. The investigation found that the bank had engaged in improper accounting practices and had failed to disclose the extent of its loan losses. Factor number 5. Regulatory issues. The Silicon Valley Bank was also facing regulatory issues around the same time. In 2002, the Federal Reserve Bank of San Francisco issued a cease and desist order against the bank, citing issues with its loan underwriting practices and risk management. As a result of these factors, the Silicon Valley Bank was forced to restructure and was eventually acquired by the SVB Financial Group, a holding company that also owns the SVB Capital, SVB Leerink, and SVB Private Bank. The bank's collapse had a significant impact on the technology industry, as many startups and other companies that had relied on the bank for financing were left without funding. The fact that the collapses have principally been in the tech and crypto spaces suggests that these sectors are even more at risk than the economy as a whole, wrote Brad Macmillan, Chief Investment Officer at broker-dealer Commonwealth Financial Network. While other banks will likely move to replace SVB, they will not be as focused or as dedicated to the sector, which will slow things down going forward. One of the primary enablers of the tech boom is now gone. This has created a moral hazard for the Fed. There will be an expectation for it to step in even if a bank gets into trouble in the future for any other issues, wrote JP Morgan analyst Vivek Juneja. But most economists agree with former U.S. Treasury Secretary Lawrence Summers, who said in an interview on Friday, "I don't think this is a time for moral hazard lectures or for talk about teaching people lessons." In conclusion, the collapse of the Silicon Valley Bank was the result of several factors, including the dot-com bubble, risky lending practices, poor management, accounting irregularities, and regulatory issues. The collapse had a significant impact on the technology industry and serves as a cautionary tale for banks and investors alike.